So the topic I'll cover today is sort of a recap on some international tax issues that we may have covered in the past, that much of them came out in 2011 and 2012. But as is the case with the topics that Annalie and Francis both covered today, they're very highly complicated areas. They're not going to be something that you're going to be able to walk out of here today and be experts on. It's more so the intention here is to just know when you're getting into trouble or know when you need to pick up the phone and give us a call. So more so to identify, if you have these certain areas that look familiar, pick up the phone and give us a call and see if there's something that you need to do or file. So carrying on with the international tax issues, there's really four things that I was going to talk about today. One is commonly referred to as foreign affiliate dumping. This is where you've got a Canadian corporation that's the subsidiary of a foreign corp. So it's foreign controlled and then subsequently invests in a foreign operation outside of Canada. So that sounds a little complicated. We'll get to it in a minute. Upstream foreign affiliate loans, these two have Canadian tax implications that you should be aware of if you've got a foreign subsidiary that is generating profits and has lent money up to the Canadian parent. There are steps that you need to take in order to avoid some unpleasant tax issues. Some basic transfer pricing concepts and issues. Really, it's becoming more and more of a topic around the world. The erosion of profits and trying to get income taxed in more favorable jurisdictions. There's really the Canadian tax laws around this also need to be looked at. Even if you're not profitable, there can be penalties that are associated with it. And then finally, the new BC property tax that came in for foreign buyers. Just a brief overview so that you have hopefully a better understanding. I'm sure there's been a lot of literature out there, news articles and that have talked about it, but this will just kind of give you a little bit more of the technical elements to it. So starting with the foreign affiliate dumping. So as I mentioned, this was introduced in March of 2012, and it involves a Canadian corporation that's controlled by a foreign corporation, and the Canadian corporation is subsequently investing in another foreign affiliate. The main issue here is the new rules create a deemed dividend by the Canadian company up to its foreign parent on that investment down to the foreign subsidiary. And the reason why this is an issue is that dividend or that deemed dividend up to the foreign parent is subject to withholding taxes. So in some cases they're reduced by a treaty, but the basic rate is 25%. So this again would be something that you want to pay attention to in case the situation arises. The exceptions where that deemed dividend does not apply if it's actually a loan that you're charging interest on from the foreign affiliate, and it's at or above the prescribed interest rate. Right now that's about 5%. Certain reorganizations where you've reorganized a group of companies within a controlled group, there's no real new investment within that group. But again, very highly technical and minimal kind of precedent so far on that. And then the other exception being they would call Canadian-centric business expansion. So if it's really the mind and management is really controlled from Canada, even though it's technically owned by a foreign corporation, and it's more closely tied to Canadian operations, then this too can be an exception on the investment down. The recourse would be really if the situation did apply. Generally the automatic is that simply the paid up capital of the shares that the foreign parent has in the Canadian company would be reduced by this amount. So at a later time, paid up capital, or PUC, is what you would be able to repatriate up to the parent tax-free, because it's like the capital investment or the original investment, so you're returning capital. In this case, if you're reducing that paid up capital, anything that you then pay up later on is going to be a dividend. So just to put it into picture so that it's a bit easier to understand, we start with a Canadian corporation. A foreign corporation becomes a parent. They hold 50% or more of the voting shares. So this is then considered to be a corporation resident in Canada, or a CRIC is what they're referred to in the different articles and legislation that you'll see. It owns a foreign corp or foreign affiliate that it owns 10% or more of the equity. It then makes another investment, whether in the form of a loan or subscribing for shares of this foreign company. And that amount then is deemed to be a dividend back up to the parent. And as I said, the basic rate would be 25% withholding tax on this deemed dividend, reduced for, depending on where that corporation is, what country they reside in, it can be reduced down to a lower rate under the treaty. But in any event, falling into that situation where you're a Canadian company thinking you're investing in, say, a US company to do exploration, and you find out later on that that investment down is actually now considered to be a dividend up to a foreign shareholder, and it's a real tax liability has been created with this withholding tax. So really that's where you want to make sure that if you do have an arrangement where this foreign parent, although they might not be acting as a controlling shareholder, if they do own 50% of the shares, you might have an issue. So as I mentioned, ultimately what would happen in order to avoid that deemed dividend, you could elect to reduce the paid up capital that the foreign parent holds in the Canadian company, and that way it ultimately it's not an ideal situation, but at least you don't have this withholding tax liability to worry about. So the next topic would be the Upstream foreign affiliate loan. So prior to August 19th, 2011, it was pretty common to have a foreign sub just lend money back up to the Canadian parent and leave it outstanding indefinitely. There was no issues with that. There was no deeming of income or anything like that. And really, ultimately, what that meant was there was no taxable dividends coming up to the Canadian parent. They were just indefinitely showing a payable down to this foreign sub. So in place of paying dividends, they were simply calling it a loan, and the cash moved up tax-free. So post August 19th, 2011, these loans now are considered to be income to the Canadian parent if they've been outstanding for 2 or more years. So if there are exceptions, of course, I'll get into kind of more of the details, but if it's beyond 2 years, then you're looking at that amount of loan being income to the Canadian parent subject to Canadian tax. So where you've got some relief is if you have a deduction available, and that arises out of whether or not you have one of these surplus account balances. And exempt surplus is essentially where your foreign subsidiary is engaged in an active business in a country that has a treaty with Canada, a tax treaty, and this accumulation of essentially retained earnings creates this exempt surplus pool. So you can claim a deduction against this deemed income that's come in as a notional dividend, because if you had the option of paying this tax-free dividend up to the Canadian parent, you should be able to say that whatever that deemed income is coming up is considered to be this tax-free exempt surplus dividend. When there's loan repayments, generally they take a FIFO approach, so the oldest gets repaid first. So if you've got a series of loans, then you would look at, first in, first out. So the repayments and the draws, you would be able to say that the oldest are being repaid first, and that would hopefully get you down so that the period of time when it's outstanding is shorter than the 2 years. And the other is for any loans that existed prior to this cutoff date, they got grandfathered. So they're deemed to be loans that were created on August 20th, 2014, as opposed to being outstanding for that entire period. So your clock would start in August 2014, and you would add 2 years from that point in order to clean up that upstream loan. But anything obviously after that date, you're on your own. So the third topic, transfer pricing, which basically the concept here is that when you have non-arm's length parties that are in different countries that are transacting with one another, you can easily manipulate the price of goods that are being passed, back and forth. And in doing so, you're going to affect the taxable income in each jurisdiction. So what the OECD guidelines are, and as well as our own Canadian Tax Act say, is that these non-arm's length parties need to go by the fair market principle. So if you're selling goods from one to the other, you need to do it at market price, and that's how you determine what ultimately your taxable income is going to be for the year. Of course, as I mentioned, the concern here is that the tax base erodes where in the country where you have a higher tax rate. If Canada had a higher tax rate than, say, the Netherlands, then you're going to favor having that income, those profits, to remain in the Netherlands, not be taxed in Canada, and minimize the price of that or the profit margin built into it. So there's been methods established that say how you determine what the price is of the goods and services that are going back and forth. The reason why this is important is, regardless of whether you're profitable or not in Canada, there's penalties that apply if CRA looks at this after the fact and says, you know what, you didn't do it at market value, and now we're going to adjust the numbers that you reported on your P&L. So that your taxable income, maybe you're still in a loss position, but the fact that they had to come in and say, okay, you need to adjust these amounts, and if they're over a certain threshold, they can apply a penalty to that, whatever that adjustment amount was. So what, in really simple terms, that threshold is the lesser of 10% of the gross revenue of the Canadian company, or $5 million. So if you had, let's say, gross revenue of $1 million, 10% of that, $100,000. If the total of all the adjustments that CRA's made to the cost of sales and the revenues on the Canadian books, if it's over that 100,000, the entire amount of adjustments is penalized at 10%. So if you had, let's say, 500,000 in adjustments, you're over that $100,000 limit, so you're looking at a $50,000 penalty, and you haven't even shown a profit potentially. So to just be aware of this, in that because you have the ability to manipulate the price on either side, you do have to take into account how they look at this from a tax perspective. And generally when CRA does come in to look at these, they require you to provide contemporaneous documentation within 90 days. So I'm sure a lot of companies, they don't actually address it until they get the request from CRA, and then you got 90 days to do your transfer pricing report. So in theory, you should be doing your transfer pricing report every year, updating it each year, so that if the time comes, they do have something to look at. Otherwise, you got to get it done in 90 days, and there's no way to extend this. So it's a pretty short time period, depending on how complicated your business is and how involved that transfer pricing study would be. So as I mentioned, there's a few commonly accepted methods. Going from top to bottom, their preference would be that you first look at what's called the comparable uncontrolled price. And essentially what that is looking out on the marketplace to say, okay, what's this item selling for on the market? So you've got something that's almost identical or comparable that you can say, okay, this on the market would be worth X amount of dollars. So that would be the most preferred in most cases when you're analyzing it. Now, if that's not available and it's a unique type of product or service where you can't really find comparables out in the marketplace, The next thing you would look at is the resale price method, which almost works backwards in saying, okay, what's my gross margin profit on these items, and what's a reasonable allocation of that? And so it's really just almost taking your profit margin, working backwards to determine what your price should be. The third one, cost plus method. This, pretty much as it sounds, you're looking at what's the cost of this product, and you're adding a comparable markup that you would see in the marketplace, whether it's 10 or 15%, then you would apply that on a consistent basis if you were using that method. And depending on what the good and service is, some of these are more appropriate than others. If it's unique, you can't find it in the marketplace, then perhaps you look at the profit margins to see, okay, is this more, or is this a better way of determining that? Transaction net margin and profit split are effectively similar in that they have small differences in the net margin, how they're being split between the two. Again, you're working backwards, going from your profit margin, working backwards to get an allocation that what the price should be. So that's mainly the brief, very brief Coles Notes version of the transfer pricing. Last item. So the new foreign property tax for BC property. So in general overview, I'm sure most of you have probably seen a lot of this already. 15% additional tax on sales to foreign buyer. It's based on the fair market value of that residential property. So if for some reason you've got maybe non-arm's length transaction happening, they won't necessarily say that it's based on the price that was charged, but they'll say, okay, what was really the market value of it in determining what that tax should be. And there's slight variation in the rate depending on circumstances. The purchaser, they consider it a foreign national. This is similar in concept to a non-resident, but it's not really defined the same way as what you would get in the Income Tax Act. But for all intents and purposes, it has the same real characteristics in determining so. Unfortunately, for a foreign buyer, there's no way to use a trust or a corporation to acquire the property instead of the individual to try and get around these rules. They will look through, be it a corporation or a trust, to see who the beneficial owner of it is. So ultimately, if it's a Canadian corporation that was incorporated by a non-resident, they won't care that it's a Canadian corp that's holding the property. It's still owned by a non-resident. And of course, it's only applying to the transfers of property that took place on or after August 2nd of this year. So again, the very brief version of the new foreign buyer tax, and evidently already taken effect on the marketplace. So I think that covers my segment for now, and Jamie will talk about the small business tax changes. Thank you.